Our next guest agrees and says buyers of investment-grade bonds will be very happy 12 months from now. Guy Lebas is chief fixed income strategist with Janney Montgomery Scott. Guy, welcome. Good to have you with us.
Thank you, Tyler.
For the first time in a long time, bonds look like not just a place to put some cash, but really investable.
Yeah, it really is remarkable. I mean, the year has been absolutely brutal for fixed income investors with interest rates rising and the worst returns, certainly since bond indexes were invented, possibly by some metrics, the worst returns since the Washington administration, believe it or not. But bond sell-offs to some degree are sort of self-limiting because at some point interest rates move high enough that there's enough appeal, even if they move higher, that they carry, that the income generation capacity is really substantial. And portfolios of 1 to 10 years, so relatively short to intermediate term investment grade corporates right now, we're seeing yields above 4.5% on average across those portfolios. And I can't recall a time in the last decade, aside from maybe a week or two of crisis periods, where we were anywhere near that level. So it is really appealing in that sense.
And then let's look at munis. What's been going on there? We said yields above 4% on munis. Boy, that is a nice way to make some tax-free cash.
Yeah, absolutely. And for individual investors, including the ones that we support here at Janney, munis are a massive portion of their overall fixed income asset allocation. Lots of reasons. Historical stability, the tax exemption being, of course, the biggest one. Now, last spring, in addition to rising interest rates, we also had some very acute weakness in the muni markets. This time around, over the course of the last month or 2 months or so, base interest rates, treasury yields, and other sort of safe haven assets have been rising, but the muni markets have been a lot better behaved. And to some sense, that makes a sell-off a little bit more buyable in munis. But the reality is for intermediate to longer term bonds, higher quality, whether it's investment grade, whether it's municipals, even government bonds, again, I think 12 months from now, you're going to be pretty happy with buying around these levels.
Do you think that yields are near their peak, Guy?
Well, it's very hard to say, of course. I think they're a lot closer to their peak than they are to their trough. That's obvious. But I would wait for a couple of signals to be more confident of that. Number one is perhaps the most obvious, a few months of slowing or at least plateauing core inflation figures. We have yet to see that. But the odds are very much skewed at this point that yields, again, 12 months from now are lower than they are today.
But so really, I think for people who need a little bit of a refresher course, as I often do with bonds, you have to remember, really what you're saying here is that if I started to tiptoe into bonds, any increase in interest rates from here might not be so drastic and dramatic as to wipe out in total return loss the yield that I would be getting from buying at a 4.5% yield on an investment grade corporate, right?
Yeah, absolutely. We talk about that in the fixed income markets as break evens, right? How much do yields or how much do relative spreads between one bond and another have to move before you wipe out 100% of the income? And when interest rates are starting at, say, 1%, that break even is very, very narrow. But as portfolios, again, of investment grade corporate bonds in the 4.5% range, right, there's a much, much thicker cushion before you start to experience net losses. So interest rates would have to move significantly higher than they've already moved before it becomes a big problem for corporate bond investors at these levels.
I hope you moonlight as a professor. That was a great explanation. Guy Lebas, thank you.
Thank you.